Most people assume taxes go down in retirement, but in this video, I'm going to show you how that's not always the case, and retirees can accidentally create huge tax problems later in their retirement without even realizing it. Hi, my name is Alex Seebakken. I'm a professional financial advisor, and I see clients too many times get blindsided by these mistakes I'm going to show you here. The first thing I see is clients automatically assume, okay, well, more income I make, more taxes I pay. Completely understandable. And they say, okay, well, if I'm not working anymore, the assumption is my taxes will drop in retirement. And to be honest, that's not always the case. And to hold this assumption for all situations, you're going to actually get stuck in a lot of issues that you don't want to be in. So here's the reality. The reality is, many retirees actually create big tax problems not even during their working years, and they have those tax problems when they're retired. Let's start with number one. Everything is pre-tax problem. What I see happen a lot is, you're working, you want a deduction, you say, hey, yeah, you can lower my tax bill, that's great. And so you start contributing to your traditional 401k. And maybe that was intentional, or maybe it wasn't even intentional. Maybe that was the default, and you just thought, okay, I just need to save some for retirement. And you didn't even consider whether it was traditional or Roth contributions. Either way, whether it was intentional or not, I see clients all the time where they have 80% plus, maybe 70%, or even more of, 70% plus of their accounts, investment accounts, in pre-tax accounts. What happens is then over those years, as you start just accumulating, all of those pre-tax accounts, they start to grow. And all of that growth is taxable as well. So you have huge accounts that are taxable, and you might be saying, okay, what's the problem now? The problem is eventually, if you don't spend down those accounts, you're trying to hold those off for maybe the later years because you want to keep that nest egg. Eventually, you might start reaching RMDs, whether it's 73, 75, where required minimum distribution. So the IRS requires you to force you to take those distributions at those ages. And now you're forced to basically take that taxable income, whether you need it or not. And if you waited to not take it, then you could have a big surprise tax bill when you reach those later years. So what can we do about it? So the purpose is we try to pay taxes on your terms, not the IRS's. So what we can do is, I see a lot, it's just a general strategy. Obviously consult an actual financial advisor or your CPA on this, is possibly once when you retire, once when your income is lower and it's before required minimum distribution age, maybe consider doing some Roth conversions, which is just gradually moving funds from your traditional IRA into your Roth accounts. Why are we doing this? We're doing this because we are basically, yes, we're paying a little bit higher taxes in those years, okay, but we're in a lower tax bracket in those years. And then when we move it over to the Roth accounts, we aren't subject to those required minimum distributions, those RMDs down the line. The second thing we can do is a little bit of tax diversification. When we do these Roth conversions, we're actually building up now, we're not so heavily in traditional. We now have a little bit of Roth and maybe a little bit in our brokerage accounts. And the point of having a little bit in our Roth is maybe we can put more aggressive assets in those Roths so the Roth can grow faster than the traditional. And that's called asset location. And we're not going to get into the full scope of this video, but just those are some strategies as we could do some Roth conversions, have some tax diversification, and maybe even consider asset location. And overall, we're filling our lower tax brackets early before hitting RMDs. The next thing I see is trap number 2, Social Security taxation. Now, this isn't necessarily a trap as the first one, but it's more of, I see clients are a little bit confused on, is Social Security taxable? Is it not taxable? And let's just settle it once and for all. Social Security is absolutely taxable if you are above certain thresholds, which most individuals are. And honestly, just to give you a general rule of thumb for everyone, is just majority of individuals, you're going to be in the 85%. So 85% of your Social Security is going to be taxable, unless your income is pretty like lower than those thresholds that the IRS sets. And why it surprises people is because you're already, maybe you're getting your pension, maybe you're taking out IRA distributions, plus you have maybe some capital gains, and adding on Social Security, 85% of Social Security on top of that, it could be a little bit surprising for retirees. And the more taxable income you have, the more your Social Security gets pulled into the tax base. So many retirees are surprised by this, and I just wanted to let you know ahead of time to expect your Social Security to be taxed up to 85%. And one other thing that we can consider is if the IRS and or the government in general is looking for ways to extend Social Security. Maybe they don't cut benefits, maybe they increase the amount that's taxable. We can speculate all day on this, on what they will do, but they could absolutely increase it to make it 100% taxable, or make it even less and make Social Security not taxable in the future. We don't know, but as of now, it is up to 85% for most individuals. What's the solution? The solution to this is if everything is in taxable accounts, you lose control of how much income shows up every year. And so if we're trying to time, I don't know exactly, which bracket you're in or how much income you have, or if you even should try to attempt to make your Social Security not taxable. But the idea is that if you can have some flexibility, have some in your tax deferred, some in tax free, some in your brokerage, it gives you a little bit of flexibility when you want to make distributions. You can choose, if you want to take the gains or if you want to take the tax or not. The next trap is IRMAA, when higher income quietly raises your Medicare premiums. First thing is there's a 2-year look back. So what this means is, let's say you had a big capital gains, or you just spiked in 1 year and in income, and your IRMAA doesn't raises immediately, but 2 years down the line, then your IRMAA premium surcharge applies, and you look back and you say, well, why did my IRMAA just all of a sudden increase so dramatically? And that's because it's looking back to your 2 years. And common triggers is if you overdo Roth conversions. Another one is you have big capital gains. Another one is maybe you have RMDs from large IRAs. And so you don't notice it when it's happening in the year it happens, and it just kind of sneaks up on you. And so I see clients say, okay, well, why did this happen? And it's like, oh, that's because it was a 2-year look back. So how can we basically address this? This follows the common theme, is we want to balance out, spread your income across your years. This is an example of 5 years, example 5 years of what it looks like of your income, and then you had a massive tax spike, okay, let's say in year 4. If we can spread across your taxable income over time and keep you underneath those IRMAA thresholds, then you don't have those IRMAA spikes, IRMAA surcharges when you're heading into the next 2 years. Trap number 4. This is later towards the end of retirement, and it's basically saying what happens when a spouse dies. And people don't consider this when in terms of a tax perspective. When one spouse passes, the survivor often files single, right? Yes, they could have those advantage tax rates, with a widow, possibly head of household, but let's just assume single. you're now basically condensing. If you're still getting a pension, if they're still getting their Social Security, they still have a, let's say $2 to $3 million portfolio, or whichever amount it may be, that's still going to generate the same amount of income whether there's two people or one person. So I wanted to show you here, this yellow line is, here's the married filing jointly tax brackets. This is, let's just say, your income when you're married filing joint, you're in the 24% tax bracket. But all of a sudden, if the spouse passes and now you're in the single tax bracket, you just jump to the 35%, paying an extra amount on the same amount of income. And so same income, higher tax bracket. Something to plan around is saying, okay, what happens if a spouse passes? Are we putting that other spouse in a super large tax bracket? And what can we do about that? What's our contingency plan if that happens? We can do long-term planning, and not only optimizing for the current year taxes, but also what happens if one of the spouse passes. We can have maybe Roth conversions conversations earlier and say, should we do Roth conversions? Because yes, we're not in a lower tax bracket for married filing joint, but compared to single tax brackets, which we may be in, it may make sense to do a Roth conversion. And also just stay aware of future tax bracket shifts. Today's joint returns won't always be next year's joint returns. Tax law changes could happen as well that affects both single and married filing jointly tax brackets. So here is the big idea to wrap up, is good retirement tax planning isn't about avoiding taxes. It's about managing when the income shows up, whether that's we're choosing to delay Social Security, claim Social Security. Are we taking distributions now? Are we not taking distributions? Are we realizing that capital gain? Are we selling that property? Are we making that Roth conversion? There's a million ways I could think of, ways to shift income forward and pull income forward. And it's not always about making sure your tax bill is as low as possible. This year, it's making sure your tax bill is as low as possible for your entire plan. And that's including as well, if you want to give it to, your kids or grandkids, making sure they inherit it as well on a favorable basis for them as well, and that you're not sticking your kids with a big tax bill if that's not what you plan on doing. That is all for this video. Thank you so much for watching. As always, if you enjoy this type of content, please subscribe, please comment on what you want to see more of, and I will see you in the next one.